Good morning, everybody. We are again here in Valencia with Didier Saint-Georges, that is Managing Director and member of Investment Committee in Carmignac. Thank you very much for the interview one more time.
Good morning.
So, first of all, what is your outlook for European financial markets in 2017, and will 2017 be different from 2016?
Well, it already is very different, isn't it? I mean, a year ago, at the beginning of last year, everybody was very pessimistic because the US economy was slowing down, China was also slowing down very much, and so the psychology was very poor. Interestingly, in retrospect, what we know now, it was the low point of the economic cycle, and since then, the recovery has been very strong, particularly driven by China, because China is China. So when they discovered that the growth was really too slow, they did whatever was necessary to get the economy going again. But more interestingly, in the US, the cycle turned up, and that pushed up commodity prices, cyclical sectors, and all that was stronger than all these political risks that took place. You remember the Brexit vote, the US elections. All these political events were actually a lot less important than what was happening in the real economy. Now, we are 1 year later now, beginning of 2017, and so we know that this economic cycle is already 1 year old. Is it close to sort of a rolling over? Is the economy going to be weaker in the later part of the year? That's the big question. What is interesting is that for the time being, what we are seeing is that to a large extent, because of Trump, because he has reignited in the US some kind of animal spirits, consumer confidence has gone up, small companies are very optimistic again. Because of that, the economy, instead of slowing down, continues to accelerate. So I would argue, that if the markets do not get derailed by some kind of political events, it could be in Europe, could be in the US, then the economy, could drive the markets further up. For the time being, we are positioned based on this observation that the economy is still the key driver for financial markets, and in Europe in particular, the numbers are starting to improve in a material way. So I think for the time being, this cycle still has some legs. We'll have to see in the second half of the year if the cycle finally comes to an end, because cycles always end up rolling over. So when that time comes, we'll have to restructure the portfolios differently. But for the time being, the economy is stronger than politics.
Where should we invest this year? Tell us about your favorite sectors and areas, and is it going to be a good year for defensive stocks or cyclical stocks?
Yeah. The idea again here to really keep in mind as a framework to understand where to invest is the fact that the cycle globally is about 1 year old. It means that some cyclical sectors have already done extremely well. And conversely, some defensive sectors have really underperformed very much. And so now, as we're getting into the end of the first quarter of this year, I think it's time to see what has gone ahead of itself and what is starting to look quite cheap. And so, for instance, industrial companies have had a very, very strong run already. I think it's getting very late to buy them. Conversely, banks, financials, probably still have some room to get revalued. So I think within cyclicals, it's already too late to just buy the cyclicals with our eyes closed. I think already now we need to recognize that some of them, it's too late to get in, and others have potential. And for defensive sectors, it's the same. I think it's too early to go into defensive, maybe for later this year, but some defensive have become already quite cheap. For instance, the pharma sector I think it's too late to get out of. And the numbers remain quite strong. They have underperformed, and therefore, what we find in our portfolio at Carmignac is that we are positioned in cyclical sectors, but not all of them. Several of them we think it's too late, and likewise, we are still positioned in some defensive sectors, but again, not all of them. Only the ones which we find have become too cheap.
And do you think a U.S. Federal Reserve is going to raise interest rates this year? And if so, when? And what about Europe?
The central banks are hesitant to move. These animals tend not to anticipate too much. They tend to wait until things happen and then they react. And so you take the Fed, you take the Central Bank of Europe. They haven't moved yet much at all. In Europe, Mr. Draghi keeps saying there's no inflation, they've got no reason to taper the quantitative easing. Mrs. Yellen, despite the inflation really picking up in the US, she remains quite careful. I think they're just worried about what the markets would do if they move. And so they try to delay as much as they can. I would think that they will not have the choice, but later on, when the inflation really picks up, which is what we think, then they will have to do something. So yes, I think Mrs. Yellen, the president of the Fed, will tighten this year. Whether she starts in March or delays further to June remains to be seen. But as inflation really picks up, and it's not only a base effect because of the oil price, inflation is picking up truly in the US today. So yes, I think the Fed will tighten. And yes, I suspect in the second half of this year, Mr. Draghi will have to be a lot more hawkish than he's been so far. And so for bond market, that's a real risk. It means that interest rates could well rise later this year.
What are the main risks we should face in 2017, and is Donald Trump one of them?
Well, the first risk I would say really is what I just mentioned. It's the fact that as people focus on politics and all sorts of other things, they don't worry about inflation. And if there is really one thing that is changing compared to the past 5 years, it's the fact that inflation now has bottomed out and is now really increasing. And it's true everywhere. It's true in the US, but it's also true in Europe. It is also true in Japan and in the emerging world. And this movement in inflation is not yet given consideration by the bond market. So I think the first risk is rising rates. And initially, equity markets don't worry about rising rates because they usually consider that it's good news. It means that the economy is improving. Until rates reach a threshold where they start worrying. So I think one of the key risks is for bond markets, and then because of the contagion, becomes a risk for equities. I think that's the big risk. Then you have the political risk. Could Mr. Trump become a problem? Could the French elections become a problem? The Dutch elections, the German elections. So yes, political risk is part of the picture. But political risk is not something you have any added value on. I mean, who knows? Even the polls, even the professional political analysts get it wrong. So I'm not going to try to measure the political risk. All you can do as an investor is to have a robust portfolio, that would not get completely destroyed if the political event, breaks the market. So I'm not going to play with the political risk, just robust portfolios. But the real risk, I think, is interest rates. And here, you have to take a view. And in our funds at Carmignac, we are taking the view that interest rates are likely to rise, and therefore, we are managing a negative sensitivity to interest rates to make sure that the portfolios will not be hurt by rising interest rates.
And finally, could you tell us some advices for conservative investors and what kind of investment funds should they look at?
Yeah, the choice of type of funds, I think, is interesting right now, because I hear a lot the argument that the bonds as an asset class are finished because interest rates will rise, and therefore they should all move their money away from bond funds to equity funds. And I think that's a mistake. I think that's a mistake, number one, because if really interest rates rise, then equity markets will suffer as well. And therefore, you can't really do well just by transferring your assets from bonds to equities. And second, because as people don't like bond funds right now, you get opportunities. And if you have the active management in a bond fund, you can actually do very well. My suggestion for a conservative investor would be to start to rebalance the portfolios between a very, very conservative bond fund, which is the Carmignac Sécurité, short-term European bond fund, and allocate part of the money that is in there in a global bond fund, which is Carmignac Global Bond in our case, which has the capacity to go negative sensitivity, invest globally, and make money with a little bit more volatility, but make money in the bond space. So a cocktail between Carmignac Sécurité and Carmignac Global Bond is really what I would recommend for a conservative investor this year.
So thank you very much for the interview, Didier. It was a pleasure to have you here again.
Thank you very much.